Welcome to the weekly deep dive on semiconductors, DRAM, and the hardware breakout. We're covering three massive events this week that are reshaping the hardware infrastructure trade, and none of them were Nvidia. We'll also break down the macro picture, breadth signals, and geopolitical risk. Here's our roadmap for today. We'll start with the market overview, then dive into breadth analysis, which is key to understanding conviction. We'll cover three major semiconductor and hardware events, analyze Nvidia's context, and touch on geopolitical risk. We begin with Section I, Market Overview, focusing on the S&P, NASDAQ, and their correlation with Treasury yields. The S&P 500 has reclaimed the majority of last week's pullback. We're seeing clean downtrend lines being broken, and multiple key moving averages have been recaptured. This defensive behavior suggests institutions are protecting key levels, making the foundation stronger. The NASDAQ is showing relative strength, primarily driven by semiconductor leadership. Downtrend lines broke with conviction and volume. When the NASDAQ leads the recovery, it signals that risk appetite is back, and growth is reasserting itself. Let's look at the 30-year Treasury yield, which peaked and then came down. This is crucial because it has an inverse correlation with equity performance. The yield dropping is a primary driver of the equity market's recovery. When we overlay the Treasury yield and the S&P 500, the inverse correlation is clear. As yields topped out and rolled over, the S&P began its upward trend. This suggests bond market participants are betting on declining crude oil prices. The key question is why bonds are being bought despite hot CPI and PPI data. Bond buyers believe crude oil will fall. More importantly, we are seeing the longest U.S. equity inflow streak since December, showing conviction and deployment of capital into equities. Moving to Section 2, Breadth Analysis. We will examine NDFI, moving average breadth, and demarcation lines to get a clearer picture of market health beyond the headline indices. The NDFI measures the percentage of NASDAQ 100 stocks above their 50-day moving average. The 50% level is the critical demarcation line for corrections. We held above 50% and are lifting, a pattern often seen at the start of sustainable rallies. This chart illustrates how the NDFI dipped near the 50% level, held strong, and began climbing. This confirmed that the market's foundation is solid and could support the next move higher. The S&P 200-day moving average breadth is the long-term measure of institutional stability. We briefly undercut and retested it, but bounced immediately. Defending this level indicates institutions are buying the dip and the foundation is improving. The 50-day breadth shows the intermediate-term trend. We've seen the ideal pattern: undercut, rally, retest, and now breaking out above it. We are currently in the expansion phase, which often precedes the strongest market moves. The 20-day breadth is the short-term swing indicator. We bounced from the 34% level, recovering above 50%. The fact that it didn't dip lower than 34% suggests strong underlying bid support, indicating that the next swing higher should have momentum. The 5-day breadth is a short-term signal. If the 50-day breadth is below 50% and the 5-day spikes, that spike usually fails. However, since we are through 50% on intermediate measures, the recent 5-day spikes are legitimate and supportive of the rally. This slide is the breadth cheat sheet. Currently, every single breadth measure, 50-day, 200-day, and 5-day, is pointing to a bullish regime. You do not fight a market where every technical breadth indicator confirms the upside. Moving to Section 3, we frame everything through the three-legged stool of macro, fundamental, and technical analysis, and why fundamentals drive the market. Macro is messy, covering geopolitics and Fed policy. Fundamentals cover earnings. Technicals cover price action. Right now, fundamentals and technicals are strengthening, while macro is uncertain. Two strong legs mean we respect the market's uptrend. As George Soros noted, it's difficult for a stock to drop when earnings keep increasing. Fundamentals drive price. The technical tail does not wag the fundamental dog. The correction only comes when earnings growth slows first. Time frame determines which leg matters. For day trading, it's pure technicals. For investing, fundamentals are everything. Paul Tudor Jones understands this difference, which is why he buys growth names despite macro risks. We move into Section IV, focusing on event number 1, AMD's CPU revolution. Lisa Su's presentation in Taipei dropped a massive fundamental bomb that changes the semiconductor thesis. AMD is revising its annual CPU market growth rate up to 35% plus for the next 5 years. This unprecedented 5-year visibility on demand means even AMD's CEO believes her prior estimates were too conservative. This is a game changer. CPUs are now central to the AI infrastructure buildout, driven by inferencing demand. Lisa Su flew to Taiwan to secure supply chain capacity for this sustained 5-year ramp-up, confirming a strong backlog. The CPU pivot is confirmed by Nvidia, who mentioned CPU frequently and accelerated their CPU timeline from Q4 to Q3. When both major players pivot, the demand is undeniably real, pulling timelines forward. On the chart, AMD shows a classic cup and handle pattern. We are currently in the clouds, trading between $391 and $475. We should expect a base to form here, but watch the $355 gap fill if macro noise forces a sell down. Look for the earnings breakout pattern. Gap up, immediate sell-off as stops are hit, hold the opening print, and then a rip higher. Institutional price points defend key levels, which is why I use the closing price for swing stops. The 22-day exponential moving average is AMD's bull-bear demarcation line. Above it, longs work. Below it, be careful. The major risk is a supply chain bottleneck, but the current demand thesis is solid. Intel is a direct beneficiary of the CPU demand spillover. When the total addressable market expands by 35% annually, both the number 1 and number 2 players benefit. Intel is back above its 12-day moving average. ARM is rallying because of the Nvidia partnership. NVIDIA's distribution model will push ARM's architecture into the expanding CPU ecosystem. This fundamentally shifts ARM's future revenue potential. We now move to event number 2, Samsung and DRAM. This relates to a union deal affecting 40% of global memory and its potential impact on DRAM pricing amid exploding CPU demand. Samsung is the memory chip giant, producing 40% of all memory chips globally. They hit an all-time high close after resolving a major union deal. Critically, DRAM prices have increased approximately tenfold overall due to high demand. Samsung reached an 11th-hour deal, avoiding a strike that would have crippled global memory supply. While the resolution removes tail risk, it doesn't solve the existing fundamental supply gap, which continues to constrain DRAM availability. DRAM prices have gone up drastically. The CPU demand explosion directly drives DRAM consumption, as more compute power requires more memory per unit. Given current supply constraints, DRAM prices are likely to stabilize or push even higher. SK Hynix offered ASML a 15% premium, over $60 million on a $400 million machine, to secure production equipment faster. This confirms demand is real, as both Samsung and SK Hynix are out of capacity and racing to build out more. The South Korean market ETF, EWY, is trading at a massive discount compared to US valuations, yet it provides exposure to Samsung and SK Hynix, the dominant global memory producers. Geopolitical uncertainty is suppressing this valuation. EWY is trading at 12 to 13 times forward earnings, significantly lower than the US market. The fundamental strength of its components suggests this valuation gap should close, despite geopolitical concerns. Companies cannot build capacity fast enough to meet demand. The STX CEO indicated they can't meet demand for product and build-out, which is bullish for pricing. If demand outstrips supply, prices remain elevated, as build-out takes years. We now introduce Section 6, Event Number 3, Hardware Breakout. This cycle is broadening to Dell, HPE, and Lenovo, signaling that the AI infrastructure demand is moving into enterprise hardware. Lenovo's earnings were an unseen catalyst. They confirmed strong AI infrastructure spending, reporting a $21 billion AI server pipeline where demand is outpacing supply. This was the true driver for the breakouts in Dell, HPE, and NetApp. Lenovo's $21 billion AI server pipeline confirms massive demand. Dell and HPE are direct beneficiaries. HPE is growing under the radar, especially with its Juniper acquisition, which is showing 150% growth. Dell's technical breakout above the $56 resistance was fueled by the Lenovo news and AMD's CPU comments. When institutional money defends the 22-day moving average on dips, it suggests strong conviction for swing positions. HPE is a sleeper name, breaking out of a year-long base in mid-April. Its acquisition of Juniper Networks, growing at 150%, is largely overlooked. This re-rating of stodgy names confirms the broadening of the AI cycle. NetApp is the closest US-listed comparable to Lenovo. The hardware breadth is significant, indicating that AI deployments are driving enterprise refresh cycles, not just new builds. Institutional accumulation is evident, with all major hardware names holding the 22-day moving average. Even Texas Instruments, an analog semiconductor name, is breaking out. When the quote-unquote photos electronics sees surging demand, the cycle is deep and broad-based. The ESO's breaking out ahead of the SOX confirms this rotation. Finally, we cover Section 7, Nvidia Earnings Context. Despite the major events we've discussed, Nvidia crushed earnings. The key takeaway is their strategic pivot towards CPUs and the consistent 8-quarter pattern of execution. Nvidia delivered incredible numbers, achieving 75% gross margins. The real takeaway from the conference call was how frequently they mentioned CPU, signaling a strategic shift for the GPU company. For 8 straight quarters, Nvidia has followed the same post-earnings pattern, a run-up before the print, a great earnings report, followed by a sell-off. This has become a known trading pattern. The key takeaway from the conference call is the pivot to CPUs. Nvidia is partnering with ARM to accelerate the CPU timeline. This is an additive revenue stream, not cannibalization, as the total addressable market is expanding. Next, let's discuss the hyperscaler spending shift. The overall spending pie is not shrinking. Instead, the chips are moving within that pie. Hyperscalers have defined CapEx budgets. The beneficiaries within that budget are changing. Tomorrow's spending breakdown will see slices for CPU, DRAM, and infrastructure becoming more meaningful alongside the dominant GPU share. This chart illustrates the shift in hyperscaler CapEx allocation. While GPU AI accelerators still dominate at 55%, other segments like CPU infrastructure and memory/DRAM are growing their allocations. The comparison to the dot-com era is flawed. Today's semiconductor companies have real earnings and huge gross margins. The growth rate is significantly higher than anything previously experienced, and the earnings are real. We now transition to the macro picture, examining uncertainty, geopolitical risks, and whether these factors are truly affecting earnings. Geopolitics, interest rates, and consumer spending are real concerns. However, tech earnings guidance is not changing. If anything, companies are ramping up their outlooks, not cutting them. The Iran and oil situation is the geopolitical wildcard. If combat resumes, crude oil could surge, and the 10-year Treasury yield would follow. Historically, oil shocks lead to market sell-offs before the Fed intervenes. Crude oil is in a triangle formation, nearing resolution. A breakout upward could see prices spike, while a deal would likely lead to a pullback, which would benefit equities. The 10-year yield has strong resistance around 4.57. A decisive break above this is problematic for equities. If oil surges and yields follow, the belief will be that the Fed cannot cut rates, but they will prioritize the economy. Historically, new Fed chairs bring volatility. Warsh's swearing in continues this pattern. While some believe he can't cut rates due to inflation, if economic support is needed, rates will come down. Finally, let's examine the Bank of America quote bubble warning, focusing on what truly matters amidst the headlines. Bank of America's bull/bear scale hitting 8 is a contrarian sell signal. Historically, this has led to an average loss of only 2 to 3% over the next few months, with a maximum drawdown of 15 to 20%. The real risk is the volume situation, not a major crash. Bank of America flagged quote slumping volumes as bubbly behavior, and this is the risk that matters most. When volume declines, the market becomes fragile, unable to absorb a sell-off effectively. Cerebra's, a recent hardware IPO, is my canary in the coal mine for the hardware sector. It was down nearly 9%, and every public buyer is now losing money. If highly speculative stocks like this roll over, it signals a red flag for the entire sector. The real bubble risk materializes when major tech IPOs, like SpaceX and Anthropic, go public. The circular funding loop will stop, and when the financials become transparent at the IPO, reality sets in. Now let's look at the money flows and positioning to see where institutions are actually moving their capital this week. U.S. equities saw their 8th straight week of inflows, the longest streak since December. However, materials, financials, and crypto all experienced significant outflows, indicating an unwinding of momentum trades. Institutions are building core equity positions, while taking profits on momentum-based trades in sectors like crypto and materials. The core equity bid remains strong, despite these peripheral unwinds. Next, we move to the technical analysis section, where we'll examine Elliott wave, divergences, and a potential Dow theory signal that requires attention. The S&P 500 closed by filling a gap and forming a gravestone doji. The high of 7,506 is a lower high compared to the May 14th peak of 7,517, suggesting a textbook potential reversal, though confirmation is required. The NASDAQ is mirroring the S&P with the same gravestone doji and lower high setup. Divergences are also forming on multiple oscillators, and if we push slightly higher, we could see a triple RSI divergence. The Dow made new highs while the S&P and NASDAQ lagged. Crucially, the transports did not confirm these new highs, which is a potential primary Dow theory sell signal. This divergence is a significant red flag. Based on Elliott wave theory, there are two scenarios. Either the 5-leg push is complete and we reverse now, or we push slightly higher to complete wave 5 and form a triple RSI divergence. Both scenarios ultimately point to a reversal. The VIX is flashing divergence signals, with the S&P making new highs while the VIX refuses to make new lows. The 50-day moving average remains above the 200-day moving average, indicating structurally bullish volatility. The S&P is testing a major resistance channel that stretches back over 100 years. This, combined with hitting a rising wedge from the 2009 low, suggests an elevated risk of reversal at this confluence of resistance. The S&P's 8-week winning streak is running into weekly resistance, accompanied by multiple divergences. This technical confluence is a high-probability reversal setup, shifting the risk/reward to the downside. Finally, we zoom out to look at the bigger picture, the wealth stock boom loop, consumer risk, and what factors are likely to bring this current cycle to an end. The wealth stock boom loop, as flagged by Bank of America, is self-reinforcing. Rising stocks lead to wealthy spending, which improves earnings, pushing stocks higher. External factors like an oil shock or yield surge are usually what break this loop. My thesis for ending this cycle is phased. Near term, an Iran escalation could spike oil, pushing the 10-year yield above 5% and tanking the market, forcing Fed intervention. Consumer risk centers on the July wall. Stimulative tax returns have provided a cash buffer, but this effect fades after July. If consumer fatigue, potentially signaled by Walmart's weakness, accelerates in Q3, the fundamental picture changes. A wild card is China banning Nvidia's RTX 5090 gaming chip, despite it being designed for compliance. This happened right after Jensen's visit and mirrors earlier bans, tightening the supply picture even further. Now we will discuss the trading framework, covering position management, stop methodology, and risk assessment. Execution is key to translating market knowledge into results. I use the closing price for swing stops to avoid intraday shakeouts caused by algorithms targeting liquidity. While this widens the stop, it helps stay in profitable trades. Adjusting size to compensate for the wider stop is necessary. My swing trade process involves buying at a setup level. If it pops, take profit and move the stop to entry, making the trade free. Let the remainder run, focusing on the closing stop level, not daily P&L fluctuations. The ESOs, or Equity-Weighted Semiconductor Index, is a powerful leading indicator. When ESOs break out ahead of the cap-weighted SOX, the SOX typically follows the next day, signaling a rotation back into large-cap leaders. The SOX delivered a massive 13% weekly thrust, confirming a classical breakout pattern. Momentum like this tends to persist, and trying to fight the move based on sentiment is highly risky. Using Fibonacci extensions on the SOX from the swing high to low, the first target at 571 was hit cleanly. While further targets are higher, expect resistance and consolidation at each level. Let price action confirm moves before targeting the next level. Despite calls for a dollar crash, it showed bullish divergence and bottoming tails on the weekly chart. A surging dollar creates tighter global financial conditions, acting as a dual headwind for equities alongside rising yields. The long-term grand supercycle count suggests we are in wave 5 from the 2022 low. Multiple monthly RSI divergences and the rising wedge hitting its upper boundary point to elevated risk for a meaningful correction. We covered macro, fundamental, technical, and geopolitical factors. Now, let's summarize the key takeaways and actionable items for the week ahead. The bullish case is strong, driven by surging CPU DRAM demand, hardware infrastructure breadth, and institutional inflows. The bearish case warns of gravestone dojis, Dow theory divergence, and the Bank of America contrarian signal. Risk management is paramount. Thank you for watching this video. Remember that you should do what you are comfortable with. Follow Hollow Point Trading on all platforms for more research and analysis.